What is going on, you guys? Welcome back to another video. Today's video is brought to you by protein powder and pre-workouts. Everyone's been commenting lately like, Brandon, man,
you're getting so fat, go hit the gym, blah, blah, blah.
I know that I'm starting to pack on the weight a little bit, so hopefully these products will get me back in shape for summertime. Thank you guys for keeping tabs and making sure that I'm on point with this stuff. But on to today's video. Today we're going to be talking about how taxes work in Canada. I know nobody ever really wants to talk about taxes. They're not really exciting, but they are important and it's something that we should understand, at least from a base level. So that's what we're going to be covering today. This should be a really valuable video for any beginner investors out there in Canada. So if you enjoy, as always, give this video a thumbs up. But we'll start today's video off kind of with a little intro or a little primer, and it kind of goes without saying, but when you earn money in Canada, whether that's through your job, whether that's through a rental property or your investment account, whatever the case is, the government will typically get a cut of that. Now, not all sources of income are taxed equally. In fact, as we'll look at today, some sources of income are taxed more favorably, some less favorably. And when it comes to investing in the stock market, really the three types of income that you're going to be receiving are capital gains, dividends, and then interest income. And it is important to be able to distinguish between the three. So we'll go through each of these one by one. But before we dive into the guts of this video, it's important to understand this right off the bat. If you're investing in a registered plan or a registered account, something like the TFSA or the RRSP, you don't have to worry about any of this, okay? The taxes that we'll talk about in this video don't apply to a registered account. That's why they get the name tax sheltered plans. That's of course one of the major benefits to using a TFSA or an RRSP, and ultimately that's probably why you should be using the TFSA or RRSP. And if you haven't seen the videos that I did quite recently on both the TFSA and RRSP, I will link those down in the description below for you guys. You could definitely benefit from checking those out, especially the video on RRSPs where we talk about how you can actually save money and defer paying taxes by contributing to your RRSP account. So like I said, those videos are down below. Feel free to check those out, but just understand that what we'll be talking about in today's video only applies to a non-registered account. So something like a cash account or a margin account. A prime example of this would be if you're someone that's using the new Wealth Simple Trade platform. This is the new 0% trading commission platform here in Canada. These accounts are currently non-registered accounts. So this is where taxes would apply. So just make sure you guys understand that. But let's hop right into things and start this video off with capital gains. And to put it very simply, what are capital gains? Capital gains are when you purchase a stock and at some point down the road, you sell that stock for a higher price. If the share price has gone up in value, if it's appreciated, you sell it down the road, that would be considered a capital gain. So you buy a stock today for $100. If a year goes by or a year down the road, you sell that stock for $150, well, you've earned yourself a $50 capital gain. It's basically the profit that you're making on that position. And how it works is that 50% of your capital gains are subject to tax. Okay, you're not paying 50% in tax. Take the example that we just looked at with a $50 capital gain. 50% of that, or $25, that $25 is subject to tax. In other words, you'd be adding that $25 to your taxable income and paying tax on that at the end of the year. Now, there are a couple points that we'll talk about when it comes to capital gains. And the first is that your capital gain is triggered in the year that you sell the stock. If you buy a stock today in 2019, but in 2020 you don't sell the stock, in 2021 you don't sell the stock, you can hold that stock for 5 years, 10 years, let that grow and let your capital gain accrue up, and it can just be getting bigger and bigger. And then if in 2030 or whatever year you decide to sell that stock, in that calendar year, that's when the capital gain would be triggered. And in that year, it will have to be added to your income. So fun little tip, if you're looking to kind of defer your taxes a little bit, let's say it's like November or December of 2019, rather than selling that stock now and worrying about paying taxes in this calendar year, if you can push back the sale of that stock a few weeks or a month so that you're actually selling it in the new year, well, the capital gain would then be triggered in the next calendar year, and then you wouldn't have to worry about paying taxes till a bit later on. You can kind of push those taxes back. Now, secondly, you may have heard of something called capital losses or tax loss selling. And capital losses are pretty much how they sound. They're basically the opposite of a capital gain. If you buy a stock and that stock goes down in value, so you're losing money on that position, if you opt to, you have the option of selling that stock for a loss and triggering a capital loss. Now, capital losses can be used to offset or kind of wash out some of your capital gains. So if, for example, in a given year you had, let's say, $5,000 worth of capital gains, if you have a position, if you have a stock, an ETF, some sort of investment that's down, let's say that investment's down $3,000, if you choose to sell that stock, you can subtract the $3,000 capital loss, and your capital gain for the year is now looking like $2,000. Now, a question that I do see a lot online, and hopefully this does clear some things up, can you utilize capital losses in a TFSA or an RSP? No, you can't. You can't offset gains in those accounts because you're already not paying taxes to begin with, okay? You're not worrying about taxes in those accounts. So selling a stock for a loss in your TFSA, your RSP, that's not gonna make a difference. This only applies to a non-registered account. Lastly, if you incur a loss, you can carry that loss forward indefinitely so that you can use it at some point down the road to offset some future gains, or you can actually carry that loss backwards up to 3 years to use against any previous capital gains. So that is definitely something that you want to keep in mind. Just of course understand that you can only offset capital gains with your losses. You can't use it to offset or deduct some other forms of income like your employment income. Capital losses are strictly used to offset capital gains. Now, moving on to dividends, and this section can definitely get a lot more confusing. So we will just talk kind of on the surface level here, but this should give you a good overall breakdown. Dividend is, of course, as many of you guys know, is basically a cash payment that you receive from holding a stock. If a company pays a dividend, you're basically receiving a little cash payment or a little stream of income, typically every quarter. And those dividends, those cash payments, like other sources of income, are subject to tax. Now, they are taxed more favorably when compared to your employment income and compared to interest income, which we'll talk about in a second. Capital gains are still taxed the best because of that 50% break that you're getting, or the 50% credit, but dividends would be the second most favorable form of income in terms of taxes. And we'll start this segment off with this. Canadian dividends are taxed more favorably than US dividends. If you hold a Canadian stock that pays a Canadian dividend, take the company BMO for example, or Fortis, those dividends are subject to what's called the dividend tax credit. And like I said, this is where things do get a little confusing. We could get into very much detail with how this exactly works. But basically, you're grossing up your dividends by a specific amount, and I can include this link that you're looking at on the screen down in the description below if you're interested in checking it out. But on a base level, what you guys need to understand is that Canadian dividends are taxed at a lesser rate. And the reason behind this tax credit, for anybody that's interested, is that dividends, let's recall what dividends are. dividends are paid out of after-tax dollars. So if a corporation pays a dividend, that's essentially coming out of their profits. They've already paid tax on that, and then for you to receive that dividend and then pay a full amount of tax again, it's almost kind of like double dipping. And that's why they do have this odd system where you gross them up and they're taxed slightly differently. Like I said, it's a little complex to get in for this video. It's a little more math than we probably need to talk about, but like I said, I will include some links down in the description for you guys below if you're interested in checking that out. Now, if you're receiving US dividends, that's completely fine. They're just not gonna be subject to this dividend tax credit. And as I've talked about on this channel before through some other videos, by default, your US dividends that you're receiving, they're gonna be withholding 30% of those dividends by default. Now, you can fill out this form called the W-8-BEN, and by filling out this form, that's gonna reduce that withholding tax down to 15%. So if you have a lot of US holdings, this is definitely something that I'd look into. But a couple points on dividends. Reinvested dividends are still subject to tax. So if you're participating in a DRIP, dividend reinvestment plan, don't think that like, oh, just because I didn't pull the dividends out, I don't have to pay tax on them. Those dividends that are reinvested are essentially treated as if they were paid out through a cash dividend, and they are going to be subject to tax. Secondly, and this is much more of a rare case, but it is worth mentioning, if your only source of income is Canadian dividends, you can actually get away with earning up to about $50,000 without having to pay taxes on that. So if you're someone that's, let's say, retired, that would be the most likely scenario where you're not earning any employment income. If the only income that you're drawing out is dividends from your portfolio, because of a combination of the personal allowance and the tax credit, you may very well find yourself in a situation where you don't have to pay any taxes on that. And I'll include this article down in the description below. The title here is "You Can Earn $50,000 in Tax-Free Dividends, but You Can't Have a Job." It's a pretty good read and hopefully can be pretty useful and clarify some things up if you find yourself in this situation. But let's move on to our final source of income before we wrap up this video, and that is interest income. And interest income is strictly related to fixed income products. So this is where you'd be lending your money out and receiving an interest rate in return. So something like a bond or maybe a GIC. And that's really an important point because a very common misconception that I hear through friends and through the internet, you'll often hear people saying like, oh, how much interest is your portfolio making you? Or how much interest are you earning? When really what they're referring to is the growth of your portfolio. That's technically not the right terminology. Interest relates strictly to fixed income securities where you're receiving an interest rate in return. Now, interest income is actually the least favorable of the three incomes when we look at it in a tax perspective. It's actually taxed equally to your employment income. There's really nothing special when it comes to interest income. An important thing to note, however, with interest is, let's say, for example, you hold a 5-year GIC, okay? So you're locking your money up for 5 years. You're not gonna touch it, you're not gonna get that back for 5 years. Each year, you're going to have to pay taxes on the amount that you've accrued. So even though you're not pulling it out, you're gonna get a tax slip every year saying that you've earned X amount in income on the amount that you're accruing, and you do have to pay taxes on that each year. And that's kind of it for interest income. It's not really the most exciting one. But in summary, to finish off this video, I will just give you guys a couple rules of thumb when it comes to paying tax in Canada. And don't get me wrong, guys, these are really just rules of thumb. Obviously, every situation is specific to your specific tax needs and situation. These are kind of just general rules to follow. If possible, because interest is taxed at the highest rate, maybe you could consider holding your fixed income products or securities like a bond. Maybe you could consider holding those in a tax sheltered plan like the RSP or the TFSA. In terms of stocks, in a non-registered account, Canadian stocks that are paying Canadian dividends would be the most optimal to hold in comparison to a US stock. Now, that being said, and this is probably the most important part of the entire video, that doesn't mean that you shouldn't hold US stocks in a cash account or in your non-registered account. If you can find a US investment that's a far superior investment than a Canadian one, but you're so worried about taxes, like if that US stock is gonna outperform a Canadian stock by miles, don't worry about the taxes on that. I'll share with you guys one of my dad's favorite sayings. It's don't let the tax tail wag the dog. Don't be so worried and focused on taxes that you're neglecting all sorts of good investment options out there. First things first, you want to worry about the investments. That's the first priority, and then the taxes come after. So just because Canadian stocks are taxed more favorably, don't let that be the reason that you neglect or avoid US stocks. Just don't let the tax tail wag the dog. I know that it does suck paying taxes. Nobody likes paying them, but the way that I like to look at it is that if you're paying taxes, at least that means that you're making money. It's really just one part of investing, and that's just the way that it is. But that'll wrap it up for today's video. Hopefully that gave you a good overview on the different types of taxes and how they work in Canada. Like I said, it's not the most exciting topic and it can be a little bit confusing, but hopefully, like I said, that did give you a nice primer and intro so that you do understand it a little bit better. If you guys enjoyed the video, do give it a thumbs up and feel free to share it with another Canadian, maybe one of your family members. If you're not already subscribed to the channel, I post a video like this every Monday, so subscribe. Thank you to everybody that's helping me stay in shape. Hopefully you guys will notice a bit of a change over the next couple months or so. And if you do want to check out our membership group, it is that first link down in the description below. But as always, I thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.